November 2010. At that time, 24 professors and market experts wrote an open letter to the Fed chairman, Ben Bernanke, suggesting that quantitative easing would lead to, among other things, runaway and aggressive inflation. Now, 10 years later, we know that wasn't the case. But inflation has been an issue for the market for over a decade. Did you realize that if you look at the inflation market itself in combination with the TIPS ETF and the Elliott wave count, you will be able to gauge whether the market is indeed pricing in inflation? Sounds complicated, but it really isn't. Let me show you how.
So let me begin with a brief explanation of the TIPS market. Now, the TIPS market is a part of the bond market that was specifically constructed to protect against inflation. Now, the way it does that is that the par value or the face value, which is the amount paid to the holder both at maturity and when a coupon is being paid, adjusts for inflation, adjusts for CPI. So when there's inflation in the market, the par value or the TIPS bond becomes more valuable. Now, the difference between the TIPS bond and the bond it is priced off of the Treasury, that spread is called the break-even. And for the purpose of this video, please understand that, as you can see here, when break-evens are going higher, then there's more demand for TIPS. There's more demand for inflation protection. They're outperforming. So to get to this chart, it has caused a lot of headlines of late. As you can see, the break-even market has been rallying strongly. We've been following it on the weekly video, and you can see since 2016 to 2017 and 18, these highs have been overcome, and so have the highs from 2010 to 2012. So the market has been pricing in inflation in 5 years' time very aggressively. And if we break that down just a little bit more, you can see the bottom here in March 2020 and a strong move higher into March 2021. It has since paused. But to understand significant pricing in of inflation in the TIPS market. Now, when we go to the TIPS ETF, now this tracks the investment results of an index composed of inflation-protected security. Now, you can't really or shouldn't really do much Elliott on something like a bond spread. You may see it occasionally, but it's not particularly consistent. But an ETF is a different story. So like the break-evens, you can see the ETF bottomed here in March 2020. The TIPS ETF has continued higher, also topped in Feb to March of 2021, and has been range-bound. So the direction of the TIPS ETF would be a pretty good signal of whether the psychology of inflation was going to continue, and this is where Elliott comes in. What to make of this pattern? Well, we've been following it closely for the last couple of years, and here's the wave count we've used on the TIPS ETF. We have been counting this as 1, 2, big wave 3 higher, and a wave 4 since. And as one would expect, the peak in momentum was in wave 3 of 3. We have had a consolidation since, and to go back to the break-evens, it topped and has gone sideways. Now you can see in the TIPS ETF, also topped and gone sideways. We have a strong line in the sand at 123.49. If this is wave 4 in a triangle, this level holds. Below here, below the wave A low, then the alt count likely comes into play, which suggests the TIPS market has topped out indeed. So the wave count can help us understand where the TIPS ETF is likely heading with this wave A low specifically, and help us understand and gauge inflation or the lack of inflation being priced into the market. Which leads the TIPS ETF or the break-even? It's not an either-or situation. We look for one to break and the other one to confirm as a signal of whether the inflation psychology will continue or whether indeed it's overheated and likely to reverse. So on the back of that, we'll watch this key low at 123.49 in wave A, and also watch it break-evens hold their low, as has been shown just below 2.5%.
The number of discussions about inflation should only increase in the quarters to come. But by using TIPS, break-evens, ETFs alongside the wave principle, we should be able to gauge whether the market is going to further price in inflation or whether indeed it's overheated and needs a pullback itself.